All attendees are in listen-only mode.
I'd like to welcome everybody along to this first webinar in an ongoing series of webinars. We've got a number of current members, but we've also got quite a few new faces as well, so welcome to everybody. Now, existing members know that I like to start things with something to put a bit of a smile on your face, and I was sent this early this morning, which I think is just wonderful, and the leadership crisis solved. Unfortunately, they've found another way to just try and solve the leadership crisis by actually making a decision, but I thought that was fantastic, so I thought I'd just share that with you and maybe put a bit of a smile on your face. Okay, now I just wanted to, as this is the first in a series, I just want to cover the purpose and the format. So the purpose is primarily for you to ask questions. I'm going to be providing a bit of a presentation, but it's really about questions, and I'm looking to provide some ongoing commentary on the market to complement what is presented in the weekend general updates. It is a forum for both traders and investors, so I'm covering everything from quite short-term activity right through to investing activity. And it'll provide an opportunity for those who aren't members to assess what I do, and some of you may choose to join at some stage. But for those of you that aren't interested in doing that at this stage, then I'm trying to provide some value for the 25 years of very hard-won experience that I've had. Now, as I said, I'll be answering questions on pretty much any aspect of trading or investing, so as long as they're basically short and succinct, and I would ask you to perhaps keep your questions fairly short so that I don't have to spend a lot of time reading them. And I might just get a show of hands from everybody that the sound is okay, and also just to make sure that you do know where the little hand signal is. Okay, great. All right, that's excellent. Thank you. Now, just a few housekeeping things. Now that you've registered, you'll be sent an auto link every week. So you won't have to re-register for each webinar in the series. It'll come to you automatically. It will be at this time every week. Occasionally that may have to vary with public holidays and the odd break that I take, which is pretty infrequent. So yeah, that'll be the normal format. Now, in fairness to paying members, I'm not going to be covering current portfolios in either the investing service or also any of the trading services, of which there are a couple, and that's really only fair to the existing members. But the positions are going extremely well at the moment, and the market's in a pretty good place, and so I won't also be covering the potentials that we're also stalking in the market as well. But certainly I'm happy to answer any questions on specific stocks. Now, I've got detailed knowledge on probably about 20 to 25% of the market, which is probably 400 to 500 stocks, with a heavy focus on resources, and in addition some industrial stocks and some biotech stocks as well. So that's really the scope of what I'm going to be able to cover. Now, let's do a quick recap of where we're at with markets in general. But just before I do that, I just need to point out that all of the work that I do is presented under the license of the Australian Financial Services Limited, and it's also general advice only. So I'm not really taking account of your particular circumstances. So let's do a quick global recap. We got the S&P in the States in an amazingly strong uptrend. It's technically overbought, but we've got the price and volume momentum, which has been strong, is just starting to wane a little bit. And I'll just go through a couple of slides and then we'll go to the charts. There's so many contrarian indicators, sentiment indicators that are screaming atop. It's not funny, so we are going to see that market roll over into a bit of a pullback of some sort pretty much any day now. The transport index continues to point to a top being in place, and we'll have a look at that index. And also the banking index, to my eye, is starting to roll over as well. It's certainly lost momentum. But what I can say is that this upward strength that we've seen since the October lows really does bode pretty well for the next few months once we get this mild little correction out of the way. And I've got a medium-term target on the S&P of 1440. And if that happened to occur around about early May, then that would be perfect, because that's a seasonality time when we can expect the market to start to cool off a little bit. Now, the reason that the US market has done so well is the liquidity injection that the European Central Bank put into the system late last year. That's really relaxed markets, and hence the positive sentiment has returned, because people now aren't fearful that the banks are going to fall over. And it's highly likely we're going to see a second tranche of money. They put $500 million in previously. There's talk that they could toss another billion or so, another trillion or so in into the mix on this Wednesday. So keep a lookout for that. And as I said, May is typically the start of a weaker period, but I think we've got a lot of market strength for at least the next few months anyway. Now here's really the evidence, and this is something that you should follow, evidence of why the markets, or the fact that the markets have relaxed in Europe. This is the 10-year Italian bond yield. When it was up over 7%, that was really disaster territory. That was unsustainable. Now that it's dropped down to under 5.5, that is really telling us all we need to know about the bond markets and financial markets in general. And that's one of the reasons that I'm reasonably comfortable about the next few months. Now we'll have a look at the Shanghai Index as well, and it's indicating that it's recovered in a very robust fashion, even at the index level. And part of that has been the cut in bank reserve requirements, and that's certainly boosted confidence in the Chinese market. And all the people that have been writing for months about the Chinese, in fact probably more than a year, that the Chinese property market was going to fall over and China was an absolute disaster, I think at this point in time they've still got some egg on their face, and the trends are looking pretty positive. Now the ASX, unfortunately, has been lagging very significantly. The energy sector certainly has done well in the last couple of weeks, and that's where the action continues to be. But my view on why large caps are generally lagging so badly is really twofold. I think the strength in the Australian dollar, let me back up one. The index value of the Australian market is largely determined by the top 10 or 15 stocks, and the price of those stocks is not determined to a great extent by local buying. It's largely determined by how much overseas money is buying into those stocks. So we're talking the BHPs and the Rios and the banks. And because the Australian dollar's been so strong, those stocks are more expensive to buy for overseas hedge funds and investors. So I think that's part of the reason. The second part of the reason, I'm equally sure, is that our political landscape and political decision making and the continual shifting of the goalposts with a minerals resource tax and a carbon tax and just all the uncertainty, I think is just causing people to go and fish elsewhere around the world. So certainly I think our politicians on both sides can take a fair share of the blame for the underperformance of our market. Now the small and mid-cap, or the reporting season is basically finishing in a day or so, and the small and mid-cap stocks have done very well, the ones that are actually making a profit. That's been a remarkably robust section of the market. However, it's still a stock picker's market. This is not a case of just put your head down and barge through and buy whatever you want to. It's very much a stock picker's market, and it's still very much about getting good entry prices as well. To me, the sectors that are going to continue to struggle: retail, media, banks. But I think some other parts of the economy are doing better than the media is portraying. There are some parts of manufacturing that are actually doing quite okay. So you probably need to take the media stuff with a bit of a grain of salt. Now, I just noticed this morning that the Commonwealth Bank, NAB and Westpac have all been downgraded by Fitch, which is one of the three major ratings agencies. So that downgrade will impact to a small degree on their cost of funds. So that's not going to be helpful either. So I really think the banks are running into really multiple problems over time. Let's have a look at gold. The consolidation leg is finished. We had a great run up from the 1550 mark. We then consolidated that move over the last few weeks. That looks finished to me, and I think we're heading for 1800 initially, and then probably 1920, and then it could kick on well from there. Silver broke above $35 last week and has some good momentum behind it, and I'm really looking for a run towards $40. Now, I hasten to add, silver is a very volatile little animal, and I would be very surprised if it went straight to $40. I think there'll be plenty of ups and downs, but I believe that's where the trend is. Now, oil is also very strong. The situation in Iran is really the wild card that's causing oil to move up, and we'll have a look at a couple of oil charts in just a minute. However, prices are overbought, so I'd be looking for a bit of a pullback. Now, I was asked today how a pullback in the price of oil would affect the small cap oil stocks. I can say probably to a lesser degree than it will the larger stocks, because the small stocks are really moving more on the basis of perhaps drilling activity, exploration activity, all those sort of things. Now, let's just quickly look at where the opportunity areas are without getting too specific about them. The oil and gas sector, as I said, is really the strongest sector. Gold producers, we are going to see a massive catch-up with gold producers to the price of gold. It will eventually happen. It's happened a number of times before, and the catch-up will be huge. It'll be 300%, 400%, 500%, possibly even 1,000% with some gold stocks over the next 12 to 18 months. So that's something that you really don't want to miss out on. Now, the other main opportunity area is in the resource service companies. Reporting season for them generally has been pretty spectacular. There have been some great results, but you just need to be very careful not to overpay, because in some cases the upside is already priced into some of those stocks. So let's go over to the charts now and put a bit of substance to this, and then I'll pass over to you for questions. So this is the S&P 500 on a daily chart. If it were to retrace the recent run from here, then I'm looking at a very mild pullback would be to 1320. A more normal pullback would be to 1290. So if that were to occur, that would get rid of some of the excess out of the market and really set us up for a good run towards 1440, which could give us a couple of very strong months. Now, we'll have a look also at the, this is the Shanghai Composite Index in China, and you can see we've had six very strong up weeks on the Shanghai Index, and it certainly looked like it's bottomed out and turned around, so that's not really telling me there's going to be a property crash anytime soon. Now let's have a look at a couple of the other indicators that really sway me to think we're very close to a pullback in the US market. I'll just tidy this up. This is the Dow Jones Transportation Index, and it is exceedingly often a leading indicator of the market turning over. And as you can see, this is a weekly chart. We've had 3 down weeks in succession now, and to me that's clearly turned over. You have a look at the MACD, it's turned over about 3 weeks ago, lost momentum, and there was actually rise in volume over the last 3 weeks as well. So to me that looks like it's peaked, and usually the main index will follow within a period of about a month. Let's also have a look at The American Banking Index, you can see here on a weekly chart, the banking index significantly above the moving averages, so it will come back to the moving averages. You can see the MACD has turned over last week, so I would expect to see a pullback in the banking index. So there are all the reasons for. I'll just have a look at the price of Apple, which is obviously the biggest market cap stock in the world now. We had a massive reversal candle last Wednesday, and I would have put money on the fact that it would continue to the downside, and it may still do that. But you can see we've had 4 or 5 up days since then, so that's a bit of an opposing view. But nevertheless, I'll stick with the overall reading of it, and that is that the S&P market is topping right about now or at some stage in the next week or so, and I wouldn't expect to see it go more than 5 or 10 points higher than where it is. So that means just a little bit of caution is worth exercising. Now let's have a quick look at oil and gas stocks. So you can see here, this is Brent crude. It was only about 8 or 10 weeks ago we were trading at just over $102. We're now at $125. So that's on Brent crude, and the other one we'll look at is the light sweet crude, and that's gone from basically $76 in October, and now it's pushing 110. So oil at the moment is on an absolute tear. Quick look at gold and silver. So we've had a good move up from the end of December. We've had a consolidation in the price of gold from the 2nd of February, and I think that consolidation's finished now, and we're now starting a renewed up move. And this is silver on a weekly chart. We had 4 solid weeks up. We then had 3 weeks sideways, and then a good break above the $35 resistance last week on silver. So really looking for a move of $5 or more on silver. Now, that's probably about all I want to cover. Oh no, there's just one other thing that I want to do. I just want to demonstrate some of the gains that we've seen in sectors that are really got strong momentum at the moment. So I'm just going to look at a few stocks in the oil and gas sector, and these are all weekly charts. First one is a company called Drill Search, and the price since it broke out really started moving, and with the technical indicators that I use, that move was really evident by probably October and confirmed by early January. And since early January it's moved from around about 80 cents and closed today at $1.45. So it's nearly doubled in price since the start of January. That's been a fantastic move. There's quite a few of them. Obviously that's not a stock you'd want to be buying into now because it's long gone and it's due for a pullback. Here's another one called Cenex Energy, code is SXY. Again, it's been a fantastic move. The indicators were really pretty loud and clear by early November when it was trading around 50 cents, and now it's trading at just over $1. So that's been a really strong move in a short period of time. And similarly, this one called BRU, Buru Energy, and it's moved from around 80 cents and actually closed at $2.04 today. So when you get into stocks that are in the sectors that are trending, and they tend to trend in cycles, then you can get some absolutely amazing results. So it's certainly worthwhile understanding where the major momentum is. Okay, well that's about all I wanted to cover in terms of formal presentation. So I'll hand over now to you for questions, and we'll see where we go from there. So the first question I've got here is on MAD, which is an oil and gas stock. So we'll have a look first of all, and for those of you who are new, I've got a process that I run through in terms of evaluation of stock prices. I look first of all at a weekly chart, and I'm looking for rises in the money flow index. I'm looking at the momentum indicators. I'm looking at volume. So clearly there was a breakout here in the week ending the 13th of January. That was around about the mid-20s. We're now up at 78 cents. What I can say is that the momentum indicators, the RSI, is significantly overbought. That can stay there for a while. Doesn't mean the price has to come back, or doesn't mean the price can't continue to go. But with the RSI that high, it is just a matter of time before we get a pullback. MACD may be just showing signs of that upward momentum starting to ease. We've had fantastic volumes, and now we're getting a bit of consolidation. So at this point, the trend looks very, very strong, and the reason that I wouldn't be buying it at this level is that it's so far above the moving averages that it has to come back to earth at some stage. So the risk reward at buying here is not at all attractive. However, if you're in the stock, at this stage it's probably worth staying with, because it hasn't really pulled back yet. It's just pausing, which is a sign of strength. Now, I don't know how far this stock might go in terms of upward momentum, but I know what it looks like when it starts to run out of momentum. So I think the only way to deal with a stock like this is to run a fairly tight exit on a stock like this, and you can see here on the daily chart. So actually, when we go to the daily chart, you can see the MACD really is starting to lose upward momentum now. But it doesn't really change my view. I still think it's just tracking sideways. I don't see a reason to get out of this stock. I would think about doing one of two things, and this is just general advice, not personal advice. But I'd do one of two things. I would either take some partial profit, just in case, because when the market turns, quite often these price of small caps can come off quite quickly. Or alternatively, just run a fairly tight exit on this. But in terms of where it might go, I can't give you any guidance on that at the moment, I'm afraid, Peter. We'll just have to wait and see how it plays out. Now, the next question is on Santa Barbara SPM, which is a gold producer. They've had their ups and downs over the years. They've had a couple of near-death experiences, and you can see that the share price really has done very, very little since about 2009, whereas a lot of other gold stocks have really joined in this rally, and we've seen 400% gains in stocks like Regis Resources and a number of others. So this stock really is lagging. I know that at their last half yearly that their fortunes are improving, so the fundamentals are getting better, but I think this is a stock that's disappointed the market quite a number of times, and you can see at the moment there's really nothing there that would get me interested in buying it. Just by comparison, let's look at a stock like Regis Resources. Now, it's moved since August of 2010. It's moved from $1 to $4.40. I'd much prefer to be on a stock like that than to try and pick the time that a stock like SBM, may finally start to do something. Okay, so the next question is on OSH. Actually, getting questions on oil and gas stocks. So this is a weekly chart. We had Oil Search is one of the top 4 or 5 oil and gas stocks in this country, developing a massive gas project in PNG, and they're going to pipe that across into Northern Australia. You can see we had a big wedge pattern formed here. We had a false breakout as it turned out on the 27th of January. It pulled back into the trading range, went down to the bottom of that triangle, and then burst out last week on very strong volume. So that's looking extremely positive. So if you're in that stock, then I'd probably stick with it. Having made such a strong move last week, I would expect a little bit of a pause. That wouldn't be at all unusual. Maybe a pause for a couple of weeks, but there's some good strength there. Okay, let's have a look at MTU, which is a telecommunications stock. Fundamentally, there's a lot to like about it. It's not expensive, and we've got a pretty good moves here from around $2.60. We're now up $3.40, and that's moving quite nicely. But I'd have to say it's more of a medium to long-term proposition than an active trading situation. Okay, next question relates to KCN. Now, it's KCN on a weekly chart. You can see there was a fairly definite downtrending channel, or is a fairly definite downtrending channel. The price had recovered very strongly. There was some disappointments leading into this price hitting down under $5 or under $6, and they were largely some short-term operational issues that have now been resolved. So the price recovered very smartly to the top of the channel, and this little sell-off in the last 6 days is about the company raising some capital. Now, their major projects are in Thailand and in South Australia, but they've got a project in South America, that in Chile, I think, that they're looking to develop. So the capital raising was to raise funds for that. So look, I'm not particularly perturbed about companies raising funds to grow their business. And at the moment, it's been sold down below the capital raising price, which makes absolutely no sense to me at all. I think they raised $70 or $80 million or something, and it's nearly a $1 billion market cap company. So I don't know why the share price has been sold off this heavily. So I'm not sure of what your purpose is, Roman, whether it's as a shorter-term trade or as an investment. So if in future questions you can give me a bit of an indication of what your purpose is, I can perhaps give you a better answer. Now, the next question relates to small cap gold stocks. Look, I've actually got quite a number of them, and I've been working through that watch list with members since the middle of last year. Basically, there's about 300 gold stocks on the Australian market, and there's about 47 actual current gold producers. Now, I've looked at every one of them in detail from the fundamental point of view, how much gold they've got in the ground and cash costs and just every single figure you could think of. And I've really slimmed that down to what I've identified as the best 10 or so. And with those, we're in some, and with others, we're just waiting on potential entries. In terms of being specific, I can't really go there, Peter, for the reasons that I mentioned before. It's not fair to current members for me to be, giving out the most valuable research that I do that members are paying for. So, yeah, but I can tell you that certainly that's a sector that has got a lot of upside. Now, the next question relates to NWE, which is another oil and gas stock. And first of all, weekly view. Certainly quite a nice price movement. Hasn't really got a lot of volume kicking in is the only thing that worries me a little bit. The price is a little bit away from the moving averages, so with the lack of volume, I think there is better options. I really do. This is a daily chart. You can see we did have some good volume spikes back here over the last 2 or 3 weeks, but yeah, look, it could be a goer, but there's plenty of others that I think are more proven, that have actually got more momentum behind them at the moment. So, but in answer to your question, is there any upside? Yeah, of course there's upside, potential upside in any stock. And the one thing about NWE is that they're in the right sector. But, trading is about risk and return, and I want to go where the risks are the lowest and the return is the largest. And I think there's many opportunities that are probably more attractive than that one. Okay, and the final question I've got relates to Forge Engineering, which is a really, really good stock. Let's have a look at it first of all on a weekly chart. So fundamentally in great shape, really solid move from the low $4 mark to about $6.40. We then got a pretty substantial reversal when the results didn't come in quite as well as some people would have wanted. I thought they were fine, but the market's pretty hard these days. We then had a better week last week. The question is this little correction over? I'd be, if you're in the stock, I'd be for the medium term. I think I've got a lot of time for it. If you're looking to get into the stock, I'd probably just keep your powder dry for the moment, I would suspect. Okay, well that appears to be all the questions for now. So hopefully you got a lot out of this webinar, and as I said, it's going to be a regular event at this time every week. So we look forward to hosting you back next week. Cheers.